Now speaking, John Campbell, Director, Investor Relations. Good morning, everyone. Thank you for joining us today. Our second quarter results reflect the impact of the COVID-19 pandemic on our customers, our communities, and our company. We reported net income of $3.2 billion, or 60 cents per share, compared to $5.8 billion, or $1.20 per share, in the second quarter of 2019. Our net interest income was $11.7 billion, down $1.4 billion from the prior year quarter. Non-interest income was $10.2 billion, down $1.2 billion from the prior year quarter. Our provision for credit losses was $4.9 billion, up $3.6 billion from the prior year quarter. Our efficiency ratio was 63.7%, up from 58.2% in the prior year quarter. Our Common Equity Tier 1 capital ratio was 11.7%, up from 11. Now speaking, Charlie Scharf, Chief Executive Officer. Good morning, everyone. Wells Fargo had solid results in the second quarter with revenue, pre-tax pre-provision profit, diluted earnings per share, and ROTCE all higher than a year ago. Net charge-offs have continued to increase from historical low levels, but overall credit quality was strong and consumer and business balance sheets remain healthy. We increased our allowance for credit losses by $949 million, primarily driven by our office portfolio. Credit card spending remains strong, but the rate of growth has slowed from the outsized growth rates we saw for 2022. Our top priority is completing the build-out of an appropriate risk and control framework for a company of our size and complexity. We are investing in our business to better serve our customers and help drive growth. We added over 1 million mobile active customers over the past year, and mobile logins increased 9% from a year ago. We've continued to make important hires, bringing new expertise to Wells Fargo and businesses we are looking to grow. We announced a 10-year strategic partnership with TDJX Group that could result in up to $1 billion in capital and financing from Wells Fargo to drive economic vitality and inclusivity in communities across America. We provided the initial grants to start a fund launched by FinTech Hello Alice to improve access to credit and capital for small business owners who are members of underserved groups, including women. The U.S. economy continues to perform better than many expected. This year's Federal Reserve stress test affirmed that we remain in a strong capital position, reflecting the value of our franchise and benefits of our operating model. We expect to increase our third quarter common stock dividend by 17% to 35 cents per share, subject to approval by the company's board of directors at its regularly scheduled meeting later this month. We've repurchased $8 billion of common stock during the first half of this year, and the stress test results demonstrated that we have the capacity to continue to repurchase common stock. Regulators have signaled that the Basel III endgame proposal, which could be out as soon as this summer, will include higher capital requirements that would be skewed to the country's largest banks. Wells Fargo reported strong second quarter results with revenue, pre-tax pre-provision profit, diluted earnings per share, and ROTCE all higher than a year ago. Net charge-offs have increased from historical low levels, but overall credit quality remains strong. We increased our allowance for credit losses by $949 million, primarily driven by our office portfolio. Credit card spending remains strong, but the rate of growth has slowed from the outsized growth rates we saw for 2022. Our top priority is completing the build-out of an appropriate risk and control framework for a company of our size and complexity. We are investing in our business to better serve our customers and help drive growth, including adding over 1 million mobile active customers over the past year, launching Fargo, our AI-powered virtual assistant, making important hires, and partnering with TDJX Group to provide up to $1 billion in capital and financing. The U.S. economy continues to perform better than many expected, and the Federal Reserve stress test affirmed that we remain in a strong capital position. We plan to increase our third quarter common stock dividend by 17% to 35 cents per share, and have repurchased $8 billion of common stock during the first half of this year. Regulators have signaled that the Basel III endgame proposal will include higher capital requirements that would be skewed to the country's largest banks. Now speaking, Mike Santomassimo, Chief Financial Officer. Investment banking revenue increased 8% from a year ago, driven by higher equity underwriting revenue. Equity underwriting revenue was up 17% from a year ago, driven by higher IPO activity. Debt underwriting revenue declined 4% from a year ago, reflecting lower leveraged finance activity. Asset management revenue increased 6% from a year ago, driven by higher average assets under management and higher performance fees. Average assets under management were up 5% from a year ago, driven by net inflows and market appreciation. Turning to wealth and investment management on slide 14. Revenue increased 1% from a year ago, driven by higher net interest income, partially offset by lower asset management fees. Net interest income increased 11% from a year ago, driven by the impact of higher interest rates. Asset management fees declined 7% from a year ago, driven by lower average assets under management, partially offset by higher performance fees. Average assets under management declined 4% from a year ago, driven by net outflows. Good morning, everyone. This quarter, our net income was $4.9 billion or $1.25 per diluted common share, both up from a year ago. Our CET1 ratio was 10.7%, down approximately 10 basis points from the first quarter. We repurchased $4 billion in common stock and expect to increase our common stock dividend in the third quarter. Our liquidity position remains strong with our liquidity coverage ratio approximately 23 percentage points above the regulatory minimum. Credit quality remains strong, but net loan charge-offs increased from historically low levels and were 32 basis points of average loans in the second quarter. Non-performing assets increased 14% from the first quarter. Our allowance for credit losses increased $949 million in the second quarter, primarily from commercial real estate office loans, as well as for higher credit card balances. Average loans were relatively stable in the first quarter and were up 2% from a year ago. Average deposits declined 7% from a year ago, predominantly driven by deposit outflows in our consumer wealth businesses. Net interest income was $13.2 billion, up 29% from a year ago. We currently expect full-year 2023 net interest income to increase approximately 14% compared with 2022. Non-interest expense grew $125 million or 1% from a year ago, and we currently expect our full-year 2023 non-interest expense, excluding operating losses, to be approximately $51 billion. Consumer and small business banking revenue increased 19% from a year ago. Home lending revenue declined 13% from a year ago. Credit card revenue increased 1% from a year ago due to higher loan balances. Auto revenue declined 13% from a year ago. Personal lending revenue was up 17% from a year ago due to higher loan balances. Mortgage originations declined 77% from a year ago and increased 18% from the first quarter. The size of our auto portfolio has declined for 5 consecutive quarters and balances were down 7% at the end of the second quarter compared to a year ago. Middle market banking revenue increased 51% from a year ago due to the impact of higher interest rates and higher loan balances. Investment banking revenue increased 8% from a year ago, driven by higher equity underwriting revenue. Wealth and investment management revenue increased 1% from a year ago, driven by higher net interest income, partially offset by lower asset management fees. Piper Sandler analyst Scott Seifers inquired, "What factors will be most important in arresting a downward move in NII and when and why might it flatten out?" Mike Santomassimo replied, "Thanks, Scott. We're expecting modest loan growth, additional outflows in the consumer space, migration from non-interest-bearing to interest-bearing deposits, and deposit pricing betas to evolve over time. We anticipate these trends to continue through the year-end." Piper Sandler analyst Scott Seifers inquired, "What is the cause of the migration from non-interest-bearing to interest-bearing accounts remaining above pre-pandemic levels?" Mike Santomassimo replied, "The deposit mix has been trending downward, with commercial deposits decreasing from 32% to 30% at the end of the quarter. This is lower than pre-COVID levels in the mid-20s. The decrease is due to excess deposits on the commercial side and people spending from their primary checking accounts on the consumer side." Bank of America Merrill Lynch analyst Ebrahim Poonawala inquired, "Mike, given the reserve taken this quarter, what visibility do you have on the CRE book's current state? How comfortable are you with the San Francisco and California markets, particularly as it relates to apartments?" Mike Santomassimo replied, "Thanks for the question. Our CRE portfolio, which includes multifamily, is performing well overall. We're seeing slowing growth rates in rents, but they're not declining. Occupancy rates in new construction are good. For office, we're seeing weakness and have taken an allowance to account for potential loan level losses over the next few quarters. We've also gone through a number of stress scenarios and feel like we're appropriately reserved." Bank of America Merrill Lynch analyst Ebrahim Poonawala inquired, "Charlie, given the squeeze on the rest of the industry, how impactful is the asset cap today in terms of Wells' ability to gain market share?" Charlie Scharf replied, "Our balance sheet is currently at $1.8 trillion, so it's well below the asset cap. This gives us plenty of room to grow and invest in our." Charlie Scharf replied, "The asset cap is currently set at a daily average over the past couple of quarters. We have plenty of balance sheet to serve our customers and the asset cap is not standing in the way of that. We still have more work to do, so it's critical that we continue on our road to complete that work." Mike Santomassimo replied, "I'm confident that our investments in investment banking, wealth management, and card products will drive growth. We have the client base and the right people to capitalize on fee opportunities. Our refreshed product line is performing well and we have plenty of room to continue to support our growth initiatives." Wolfe Research analyst Steven Chubak inquired, "What gives you confidence around an inflection in lending activity given the flattish loan growth this quarter?" Mike Santomassimo replied, "We're seeing growth in card, with some growth in asset-based lending and leasing in the commercial bank. Middle market is flat this quarter, while consumer items are hopeful for growth in the second quarter. Our guidance is designed to not require every assumption to go in our favor, with the biggest drivers of uncertainty being deposits and deposit pricing, with loan story having a lesser impact. Wolfe Research analyst Stephen Chubak inquired, what is the exit rate on expense once the headcount reductions are fully captured in the run rate? Are there plans to reinvest the windfall back into the business? Mike Santamassimo replied, our focus on expenses remains the same. We're committed to being disciplined and executing on our plans for efficiency. As we approach year-end, we'll review our budget for next year and provide an update on any changes. Charlie Scharf replied, our expense guidance is based on a series of decisions that take into account our performance in the environment. We have the ability to adjust our spending each quarter, depending on how we're performing. We look at business development, product enhancements, and other subjective expenses when budgeting. We'll make a determination at the end of the year, but we remain focused on driving efficiency throughout the company. Evercore IC analyst John Pancari inquired, could you provide an update on your buyback plans? What does the Basel III endgame mean for the pace of repurchases? Charlie Scharf replied, our company has substantial excess capital above regulatory requirements and buffers. We anticipate that capital requirements may increase, but we believe there is still room to continue our buyback program in a prudent way while building the required capital and maintaining our desired buffers. We expect to learn more about the proposed regulations later this month or early next month, which will help us determine the exact amount of room we have for buybacks. Evercore IC analyst John Pancari inquired, what could be the implications of a 4% Fed funds rate on NI in 2024? What is the near-term deposit trajectory? Mike Santamassimo replied, I'm not able to provide much clarity on 2024, but it's important to consider rate betas on the commercial side, which are high when rates go up and down. On the consumer side, there hasn't been much movement. As we and others have discussed, there may be a lag in repricing after rates peak. We've seen consistent performance across deposits over the last couple of quarters and no major shifts in behavior. As we get closer to the end of the cycle, we've likely seen most of the mix shift and repricing already. Charlie Scharf replied, we are not providing guidance for 2024 yet, however, we have been consistently earning in NI and remain committed to our 15% ROTS target. We are confident that we will achieve this goal by growing our fees, controlling expenses, and utilizing forward-looking capital reserving. Morgan Stanley analyst Betsy Grisek inquired, how much of the reserve build in commercial real estate is coming from California office, particularly the property that sold at a discount on California Street? Mike Santamassimo replied, Betsy, it's not just California that's seeing weakness. It's a trend across many cities. It really comes down to the specifics of each property and borrower. We've seen clients reinvest in buildings even when lease rates are low or the building is empty. It all depends on the building, borrower, and other factors we discussed. Charlie Scharf replied, yes, we have conducted a thorough review of our office portfolio. We have taken into account the structure of our loans, lease rates, and potential termination dates to determine the appropriate level of reserving under CECL. We have been diligent in our analysis and have considered all potential scenarios. Morgan Stanley analyst Betsy Grisek inquired, can you provide an update on the reserve build for commercial real estate loans and how much risk there is for further increases? Charlie Scharf replied, we have taken into account all the risks, including refinance risk, in our portfolio review. We are being holistic in our approach in looking at current rate environment, cap rate expectations, and other factors. We are trying to be forward-looking and stress test scenarios to ensure we are adequately prepared for any potential losses. We have provided additional disclosure to show the level of reserving that exists in our office portfolio and CRE. RBC Capital Markets analyst Gerard Cassidy inquired, Mike, what changes have you made to your balance sheet management in the past year and how do you anticipate that impacting the second half of this year and into next year? Mike Santamassimo replied, Gerard, the balance sheet remains largely unchanged. We have made some minor adjustments to add a bit of duration, but overall it is similar to what it was before. RBC Capital Markets analyst Gerard Cassidy inquired, can you share with us some of the workout solutions you're using to get through this period of adjustment in commercial real estate? Mike Santamassimo replied, we strive to ensure our loans are set up for success by making structural enhancements and partial paydowns when necessary. We also look to refinance in turn to give borrowers more time to work through their issues. We don't want to kick the can down the road, so we address any real issues immediately. UBS analyst Erica Najarian inquired, can the OCC and Fed joint statement of June 29 help provide solutions that would allow you to work with your borrowers and delay classification deterioration or classification to TDR? Mike Santamassimo replied, Mike here. TDR no longer exists, but the guidance is similar to what was issued in 2009. We've been proactive in working with our borrowers to find solutions to difficult circumstances. The intent is to be clear that people should continue to work with borrowers to find solutions, which is what we do all the time. UBS analyst Erica Najarian inquired, what is the average loan size in SIB? Mike Santamassimo replied, I don't think loan size is the most important factor. What really matters is the variables Charlie discussed earlier, such as the property's condition and performance. UBS analyst Erica Najarian inquired, Charlie, what portion of the $800 million increase in outlook for this year is attributed to severance costs? Mike Santamassimo replied, the single largest piece of our exit costs is severance, which accounts for the majority of the total. There are also some other costs associated with exiting lease space and other properties. Deutsche Bank analyst Matt O'Connor inquired, Charlie, could you provide a few examples of the regulatory issues you are addressing and when you expect them to be resolved? Charlie Scharf replied, I want to be clear that there is a lot of work to do in order to meet the requirements of all the consent orders. We have implemented a lot, but there is still more to do. Ultimately, what matters is that we get things done on time and with the quality that our regulators and we expect. We have been careful not to put dates out there as we must do our work and then our regulators must review it and ensure it meets their satisfaction. We are continuing to move forward. Deutsche Bank analyst Matt O'Connor inquired, what progress have you made in implementing your plans? Charlie Scharf replied, yes, I understand the importance of the questions you are asking. Our goal is to ensure that our regulators are satisfied with our work. At this time, I cannot provide any further information beyond what I have already stated. I appreciate your interest in this matter. JP Morgan Chase & Company analyst Vivek Juneja inquired, can you provide us with the maturity schedule of your office CRE loans, including the percentage or amount maturing in the second half and into 2024? Mike Santamassimo replied, Vivek, our loans are typically 3 to 5 year loans in the commercial real estate space. JP Morgan Chase & Company analyst Vivek Juneja inquired, Mike, when did you slow down the origination of new office CRE? Mike Santamassimo replied, I believe that we have been refinancing existing facilities over the past period, resulting in a portfolio with an average life that gives a good sense of the approximate maturity schedule. JP Morgan Chase & Company analyst Vivek Juneja inquired, what is the average life and maturity of multifamily loans? Portales Partners analyst Charles Peabody inquired, can you provide an update on the progress of the mortgage banking simplification and downsizing efforts related to the remaining 6 consent orders? Mike Santamassimo replied, yes, Mike here. There are 9 public consent orders in existence. Each one is distinct and outlines what needs to be done to satisfy it. I suggest reviewing the documents for a better understanding of the requirements. Portales Partners analyst Charles Peabody inquired, what is the frequency of your interactions with regulators regarding progress in mortgage banking? Mike Santamassimo replied, we are in constant communication with our regulators. We have regular meetings and discussions at all levels of the company. Additionally, they are on site and we talk to them frequently. I'm aware that the consent orders are of great importance. We communicate with the regulatory organizations regularly and provide updates on our progress. Ultimately, however, it is their holistic review that determines whether or not the order has been completed to their satisfaction. Therefore, I'm cautious about drawing any conclusions from our view of the work or any interim comments we may receive from them. Portales Partners analyst Charles Peabody inquired, have you submitted anything yet regarding mortgage banking? Charlie Scharf replied, I'm sorry, but I cannot provide any information on that topic. I have been consistent. Charlie Scharf replied, thank you everyone for your time on today's call.